Welcome to the Midweek Market Update, where I do a technical analysis and give you my thoughts on SPY the Qs and IWM. After that, we will be taking a brief tour through our core list of companies, and if you stick with me towards the end of today's video, I've got 4 additional trade ideas to share with you, so definitely stay tuned for that. Let's kick things off here on the SPY daily time frame chart, and then we'll jump into the sectors and other intermarket components. What do we see here from a price action and structural perspective? Certainly a decent-sized upper wick on today's session, but more importantly, a solid red-bodied bar as well, closing extremely weak down at the lows of today's session, and also violating this area of daily support and the lower edge of the weekly expected move. Everything that we've just described does chalk up as being more of a bearish than bullish data point, no doubt about that. Now, this is largely coming on the heels of the 75 basis point rate hike that we were given by Jerome Powell today, but more importantly, his hawkish comments made in the press conference really took a toll on the market into the close there. We'll talk more about the economic perspective, the macro narrative, if you will, when we dive on over to the TNX momentarily. But for now, on the daily time frame chart into Thursday and Friday, I really think that there are 2 competing viewpoints that are going to battle out and see who ultimately wins into the close of the week. Situation number 1 is looking at this in much more of a bearish and pessimistic light as opposed to a bullish one, and rightfully so given the close of today's session, right? We would say that, sure, we've closed underneath the neckline of this weekly double bottom. This is a breakdown from the overhead balance area. It looks more bearish than bullish. So those people, of course, want to see the market lower. However, there's a more optimistic way to look at the market as well, and as you guys know, I'm slightly more optimistic about the market. It would be looking at this as the original balance range, right? We know that, and 372 still having a possibility of offering a higher low to the marketplace. From a trend count, you've got low, higher low, possible higher low still at 372. This has been the number that I've been discussing in the past couple of episodes here on the channel. It's not a guarantee that it holds, but if we're above 372, I'm not yet really willing to throw in the towel and flip to being a bear just based on the structure that I walked through of the higher lows being in place. The last supporting piece of evidence that would also sort of offer confluence around this area for support would be the Fibonacci's, which we discussed in the weekly watch list video from Sunday, right? We've got the 38.2 stacked in here as well, which is offering some bit of support. And we also, ironically enough, we closed right at the level that's really the number, right? 372 is slightly underneath, giving us some breathing room, also representing the balance range here. However, if we flip to an hourly chart, here's the hourly, right? Look at where the gap filled and look at where the opens and closes of these candles are, right here. Right? That's exactly where we went on today's session. Now, again, it doesn't guarantee that we hold in the post market. We're actually down slightly. We're 374.03 by 373.98. So down slightly, but you get the gist. We're kind of sitting at some pretty important support here, both on the hourly, daily, and from that Fibonacci perspective. So again, it doesn't guarantee a hold at 372, but you could reasonably make the argument that higher lows would be produced as long as we're above that area on the daily time frame chart. So what do I want to see going into the end of the week? Well, number 1, I think that this is kind of a no-touch zone in the SPY for both of those reasons that we've just discussed. You've got bulls and bears competing. I probably think you'll get some chop in this area. So don't be married to direction in between 372 and 378.50. If we were to poke above 378.50, then of course that supports my bullish narrative, the more optimistic one. And now we've got, from the daily perspective at least, a look below and fail. And then we should rotate to the top end of the range. That would be the target here at 389.50. Now, if we crack underneath 372, then absolutely, I will change my tone if we get some price acceptance underneath 372. But in this little range right here, I'm not quite willing to flip just yet. And we'll talk about some bullish evidence as we filter through the sectors momentarily as well. So that's my focus here on the SPY daily time frame chart. No touch zone, bullish above 378.50, and willing to at least entertain bearish possibilities underneath 372. I probably wouldn't advocate for a new money short given that we're outside of the weekly expected move, but into next week, if we got something that looks like this, of course, that lower high sets up the move into here, 356.75, the rotation to the bottom end of the original balance. Okay, so that's what I've got for you on the SPY daily time frame chart. Now let's look at some supporting evidence. You guys know that I'm more optimistic, so let's see if we've got things that sort of neutralize the bias here. So in the so this is the internal screen, by the way. For those of you who don't know what it is, top right-hand corner is a tutorial on how to set it up, what it all means, and how it'll help you intraday. But on today's session, we typically look at negative 300 million, positive 300 million in the volume read to determine whether or not there was, meaningful activity. And notice that on the bear side, we nearly doubled that significant read. So this does check out as being more of a bearish evidence point as opposed to bullish evidence point. However, I would just point out that sometimes, not all the time, on the follow-up day to a large announcement-driven move, like what we saw today, you will either get something that confirms or denies the extreme reading that you got. So I really think that tomorrow's volume read will be more important. Sure, there were some pretty heavy outflows during today's session, but if tomorrow it's just buy everything right back up again, then that would be pretty telling as well. Let me know if you want like a follow-up recap. We'll do maybe a shortened video tomorrow. Let me know in the comments section if that's something of interest, and maybe we'll entertain that possibility. But so, opening above and trending positively tomorrow would sort of indicate that this might just be a flash in the pan, an overreaction. But if this is still bearish tomorrow, of course, that solidifies the idea that, okay, maybe we head underneath SPY 372. So volume is really the main takeaway. I would really focus on this upper left-hand quadrant for tomorrow's session at the close. Ticks, we can't really read into, way too volatile, really only an intraday measure there. And the advanced decliner would just also indicate some bearishness, not getting any price acceptance or really any acceptance in the market above the zero line, meaning that no stocks really closed out the day to any significant skew above their opening print or the prior day's close, right? So overall, internals do support more of a bearish thesis. However, again, the follow-up day is usually more important. So let me know in the comments if you'd like to see that from a video perspective here. Let's take a look at the market profile. Again, I've got a tutorial for you in the top right-hand corner. If you don't know what this screen is, this one is pretty interesting to me. If you look at where the point of control was left on today's session, that's this green bar right here, yellow, green, whatever it is. It's the place where the most contracts were traded on today's session, and it's obviously much higher than where we closed on the day's session. So this is where the market found balance. This is where the market was content, and we've clearly driven far, far away from that. So usually this kind of acts as a magnet, not every time, but the market is more content here as opposed to being down here. Now, if we rotate higher, notice that we've got thin volume through this. It's not technically a spike because we have more than just single prints here, but if I zoom in on this profile, notice that the structure is fairly thin from a volume perspective as long as we're underneath, what is that, ES 3830. So roughly 3830. As long as we're putting in a lower high underneath that, I would entertain the no touch zone on the SPY chart and even say, okay, maybe there are going to be some bearish possibilities here. If we get back above that and we can accept near that point of control, then guess what? My SPY 372 is holding as a higher low, and maybe we see the look below and fail on the daily time frame chart. So that's just a key takeaway here from the market profile, noting that we've got thin structure. It's something to pay attention to. 3830, 3835. It's only a 5-point range. It's not really that large. Treat this as a buffer zone. If we clearly come up, reject off of it and move lower, bearish. If we accept above that, look below and fail, is unfolding on that SPY daily time frame chart. So that's what we've got from a market profile perspective. What do we see here now from a sector perspective? So who was leading, who was losing, and where was the weight? The XLY was at the top of the list, but that's because it was down the most, down 3.69%. That, of course, is consumer discretionary, fairly heavyweight sector there, and it's been lagging for a little while. XLU is at the bottom of the barrel, meaning that it was down the least, and that was only down 0.64% on today's session. D for defensive sector there, also lightweight. We'll take a look at that chart momentarily, but where were the heaviest weighted components of the S&P? So the XLK, the tech sector, is the heaviest weighted sector of them all. That was down fairly significantly up towards the top of our list here, down 3.39%, which makes sense as rates are rising. That's not good for tech, so it kind of checks out as being reasonable up there considering the market context today. The XLF for financials, down towards the bottom, again, checks out as being reasonable considering that they, I don't want to say continue to benefit in a higher rate environment, but certainly are not as impacted as tech. And given the rate hike, it makes sense. Checks out, right? Then last but not least, we've got the third heaviest weight, second by market cap, the XLV, the healthcare sector, which was down 1.47% on the day's session. So everything's red here, but the heaviest weighted component is down up towards the most. Not really ideal to see. Let's continue to check in on the structure of these charts. I think this will reveal everything that we need to know. XLY can't get out of its own way. It does look like it's starting to become more bearish than bullish, obviously breaking down from the defined balance. This is the CPI gap down. If we crack these lows, doors wide open for about a 5-point slide into 130 here, being a heavier weighted component of the S&P 500, definitely bearish, never being able to get out of its own way in the first place. Also relative weakness. pretty bearish, right, from my perspective here. Next up, we've got the XLK, the tech sector, the heaviest weighted component of them all, also looking quite bearish. Now, I know what you're saying. Why are you so optimistic about the market when the sectors are looking bearish so far? Hold your horses. We'll get to the XLF and the XLV in just a moment. Hint, hint, right? So XLK, what do we see here? Certainly breaking down underneath where we would have been putting in a ideal higher low at 123.50. You can see we've got the firm close underneath that. This is kind of the equivalent of the SPY no touch zone, because technically speaking, you could get something that looks like this as a higher low on the daily chart if we reverse and put in the equal high. It's obviously yet to be determined. It would require quite some time to pass in the market, but this is kind of like, okay, neutral, lack of kind of trend in that area. Technically, we've got the higher high, right? But are we putting in a lower low from here to here? Possibly. So no trend, not really enthused about the XLK being under 123.50, but above 119.75. If we pop back above, it's the same situation as the SPY. Look below and fail, target the top, and underneath 119.75. This is a very dangerous tipping point in the XLK. If we crack 119.75, kiss this thing goodbye. I wouldn't even really read into this too much. I would honestly just look for the equal low from the CPI gap down, much closer to 113. So one step at a time, but 119.75 will be my critical watch into the remainder of the week. If we're above it, it does check out as being slightly more neutral in this overall sideways trend now on the daily time frame chart. Let's take a look at the builders, not builders materials, I know. And this is a lightweight sector, right? So I'm not going to read into it too much. Falling out of the overhead balance, clearly a strong possibility of a higher low as long as we're above 70. Not really concerned about it. It's not going to make or break the marketplace. Does look more bearish than bullish, but again, from a trend perspective, as long as we're above 70 and put in some kind of turn here, it's a higher low. Got to be bullish on the new uptrend that's forming. Next up, we've got the XLC. What's going on in communication? Certainly a heavier weight sector, so let's read into it just a little bit more. Just like the XLY, lagging, obviously. There is your original balance. Could never really get out of its own way on this fake out up above. We know that Google earnings had a lot to do with this. Google breaking down today, dragging the XLC out of the balance and into the CPI gap down low. So to me, this is kind of looking for continuation to the downside, noting that this is only day one of a breakdown from balance. Now, we did double the balance range, right? So that target, that trade has been fulfilled. We could see a bounce off of this area, but you're just looking for lower highs and then continuation in the downward direction, which of course is bearish for your S&P 500. Next up, we've got the energy sector. What's going on over here? Oops, we want to zoom, not scroll. Let's try that again. And what you'll notice, of course, is more of a bull flag look. It's certainly not pressing down into any aggressive lows. It's not, threatening a breakdown of higher lows. So it looks fine. And again, it looks more bullish than bearish. However, remember that this is D for defensive. Not really a great look for energy to be holding up here, which of course is more of a bearish data point for your S&P 500. I know you're saying, how can you be optimistic amid all of these bearish data points? Hold your horses. We're almost there. XLV, XLF. What do we see here in the XL? RE. This is real estate, of course, lightweight sector. With rates rising, it makes sense that this is coming off a little bit. Lightweight sector, it's not really going to have a dramatic impact on the S&P 500 itself, but remember the wealth effect. As people's home values deteriorate, makes them feel less wealthy, less likely to spend money. That will ripple over to your XLP and XLY, right? So overall, this heading lower, I wouldn't really say it's a big deal until it starts making new aggressive lower lows underneath 34 roughly. So a lot of time to go, or a lot of distance rather to travel until that ultimately happens, but nothing really exciting happening in real estate currently. Makes sense with rates rising, right? That would be off. XLP, consumer staples, coming in a little bit. Again, what does this chart look like? It looks like a reasonable pullback in a breakout of a trend, right? This is the original area. We could pull back all the way to the top of that at 70 and still be putting in a higher low on the daily time frame chart. So lows, higher lows, higher lows. That would be fine for the XLP. Now, granted, XLP is defensive, so we're seeing more of a rally in the market based on value and not so much growth, which is your XLY. That's the ratio we'll look at in just a moment. But overall, noting the structure of the XLP itself, not on a ratio or anything, the structure looks fine. It does look bullish. It's a reasonable pullback after a massive rip your face off rally from this range. Did we double the range? Absolutely. That target has been fulfilled. So is it reasonable to see a pullback here? Yes. I'm not overly concerned with this chart, noting that even if it does continue lower, it'll be slight bearish pressure into the end of the week. But if we turn at 70, okay, maybe we're back in the mode of a defensive rally here in the S&P 500. So watching the 70 handle in the XLP like a hawk. Here we go. This is where things get interesting and juicy in my estimation. XLV is the second heaviest weighted market cap component for the S&P 500. Notice that we're just consolidating in the range. We did not even break down into the gap underneath us. Never mind that. Here's the really sloppy balance area. We could technically pull back and close this gap from here and put in a higher low at 127. So am I concerned at all with the S&P 500 breaking down when the XLV is holding up at the highs? Not really. right? Not really. Now, granted, yes, if this continues to pull back, it will materialize as bearishness in the, not the XL, whatever, the SPY into the end of the week. But from a structural perspective, there's a high likelihood that if the trend remains up here in the healthcare sector, a bounce off of this gets the SPY back in gear. So I'm not married to long-term bearish thinking until this clearly starts violating trend. Remember, second heaviest weighted sector by market cap. So this is really, really important to watch. I love this consolidation up here. Even with a bearish engulfer, we didn't violate this structure. Again, could it move lower into the end of the week? Yes, and that would translate to a bearish SPY, but I don't want to commit myself to bearish thinking if this is still in an uptrend. Okay, so this is competing directly with the XLK in terms of market weight, right? XLI. What's going on in industrials? This is now, I used to say infamously 7% of the S&P. Has actually bumped up to roughly 8.1, 8.2, something like that percent of the S&P 500. Again, this chart looks fine. Reasonable pullback here after a ripper of a rally. This is D for defensive. This is not something that really drives new growth in the market. So it's still a defensive rally in the S&P 500. But even if this pulls back and returns to an uptrend off of this set of lows, all good from a trend perspective. XLF is pairing with the XLV in a beautiful manner to, again, produce a solid little pullback here in a little pullback in a solid uptrend, right? If you were thinking about this as a weekly double bottom breakout, we've still got plenty of ways to go until we're even close to testing the neckline at 3250. So the XLV and the XLF, hopefully you can see this clear as day, are why I'm still slightly optimistic about the S&P 500. I know the XLK is bearish, I know the XLY is bearish, but these two hanging on with really impressive new uptrends from a structural perspective certainly have me feeling more optimistic as opposed to outright bearish. Again, if it does pull back into the remainder of the week, it will materialize as a red S&P 500, but when and if we get to 3250, you better watch yourself if you're overly aggressive on the short side in the S&P 500. That's all I'll leave it at. Next up, we've got the XLU for utilities. Remember, D for defensive here, so don't want to see it aggressively leading the charge to the upside. It was a little bit of a rally, but it's still contained within this overall sort of range. If you remember, the first dead cat bounce took us here, and now we're just kind of chopping around in here. It was down, up, kind of sideways through here. So they're up a little bit, but nothing really to the point where I would be overly concerned like energy. Energy is obviously trading up towards those highs. Utilities, not so much. So we'll leave it at that with the structural charts. Let's go on over here and take a look through the ratio grid now. If you don't know what this screen is, top right-hand corner's got you covered with a little tutorial there on how to set it up. Here we go with a quick interpretation. The top four are the risk-on sectors. XLK looks terrible, right? With the equal lows, sort of descending triangle look. Looks like it's ready to break down, which of course is bearish for the marketplace. The XLV, the healthcare sector, second heaviest weight by market cap, looks incredible. XLF, third heaviest weight by market cap, looks incredible. XLY, not doing so hot, right? Obviously rolling over here, big new lower lows, and also firmly underneath now a descending 50 SMA, more of a bearish look here. So with two things pointing down, two things pointing up, we are not in risk on mode by any stretch of the imagination, primarily with the cause for concern being the XLK, so bearish, threatening that breakdown of the level. The bottom four are the risk off sectors. Now notice what's going on here. It's very similar, right? We've got the XLP rolling over. So it's a good sign, right? That's defensive. We want to see that not pointing aggressively to the upside. The energy sector is the thorn in the side. Utilities are perking up, but really not impressive underneath a descending 50 SMA. That's the gold line on these charts, by the way. And the real estate sector as well is defensive, and it's just kind of hovering down here, finally flattening out a little bit and not aggressively trending lower here, right? We want these things to cool off, but we don't want them aggressively breaking down. So energy, thorn in the side, tech, not really perking up here. Those are the causes for concerns in the ratio grid. Here's another one. Remember, I was talking about a defensive rally in the S&P 500. So this is that chart, right? This is the XLY compared to the XLP in a ratio. And notice that, when the market wants to rally on a firm basis, boom, this is pointing in the upward direction because the growth nature of the XLY, consumer discretionary, is more attractive than the value nature of the XLP, consumer staples. Notice that this chart, even as we've been rallying here, we got a little bit of momentum higher, rejected by the 50 SMA, and now we're sitting on these lows. So this is a bearish data point, right? If this breaks down for new lows in the ratio, I would expect the S&P to go underneath 372 in your SPY, right? So this is something that I'm keeping an eye on. And yes, it does support more of the bearish look for the marketplace. Let's take a look at the dollar because the dollar's been perking up as well. off of the primary support trend line. We talked about the breakdown of the secondary. We kind of, not to pat ourselves on the back, but nailed that move there. And now we're perking back up off of the primary support trend line. So dollar's still technically in an uptrend. This secondary is just, it's kind of minor in the grand scheme of things. If we scrunch this up, I mean, we've just reset, quote unquote, to the dominant trend, and we put in a higher high here from here to here. So the first time you test your primary support trend line, it should be a buy. And we certainly did bounce off of it with the Fed raising interest rates again today. We certainly saw some upward momentum there in the dollar, which is a bearish pressure for your S&P 500. So you want to see this either cool off and continue to compress, right? We can now draw in a resistance trend line. This is the point of including it in today's video, is we've got something that looks like this, and we can get rid of the secondary support now that it's broken. But if we reject off of this, okay, that's your SPY no touch zone in between those two levels. If the dollar pops through that and makes a new high into this area, then guess what? You're probably underneath SPY 372. All right, so that's what I would watch for in the dollar here. Next up, we've got the TNX. Let's talk about Jerome Powell and what unfolded on today's session. So obviously, market likes lower rates, market likes sideways rates. Notice that rates actually went sideways even amidst a rate hike. Now, of course, there's a market for bonds and notes, and that's kind of what drives the yield here. And I know it doesn't respond immediately is what I'm getting at. So from a macro perspective, we should be supporting higher rates here. But yes, there's a market that needs to respond first before this is going to do anything meaningful, right? So TNX should be moving higher. And if it does move higher, and if it does hold this support trend line and the trajectory here, of course, that's more of a bearish look for your S&P 500 watch for this to roll over. However, if it continues to go sideways, and guess what? Maybe that market for bonds and notes doesn't want to bid in the downward direction anymore because it's inverse, right? Then so be it. Rates stay stable and sideways around this four handle, even if the FOMC and the Federal Market Committee is supporting rates at a higher sort of level. Okay, so just something to consider. Doesn't mean that it's got to be that way. Again, I would rather see this cooperate with what the Fed's doing than give us some sort of massive divergence that makes things more tricky. Okay, so that's the TNX. Higher probably leads to lower here in your S&P 500. Let's briefly talk about what went down with Jerome Powell's comments. I've got a new chart to sort of show you here. It's the Fed funds rate over the SPX is underneath here. So let me just make the zoom relative to itself. And where are we? There we go. Looking good. So every single time you see a red vertical line on this chart indicates a Fed pivot. Right? Every time the Fed pivots, meaning that they go from a restrictive stance to a more accommodating stance, that's where you see a red line here. Now notice, every time in the past that we've seen a red line, it precedes the dominant sell-off. It precedes the dominant sell-off, right? So rates come down and then the market collapses. Rates come down here, market collapses, so on and so forth, right? Now, this has been a historical trend, but Jerome Powell said something very interesting in today's press conference, which I actually want to bring up to you in today's talk. Markets have evolved, so to speak, since these previous instances of a Fed pivot. And he said word for word that the markets are now more forward-looking than they used to be, right? So the market is going to act on any sort of indication that in the future, the Fed might change their stance, right? So I don't necessarily think that we need a Fed pivot and then we're going to get some sort of continuation to the downside. I think that a Fed pivot will come and then the market pricing that in, we may see some sort of upswing. So I don't think that this indicator will be as solid as it has been in the past, but it is just something that I wanted to bring up to you in today's session. Of course, during his press conference today, Jerome Powell said that rates will be higher and for longer than originally forecasted, right, in that SEP. Now, here is the unemployment rate overlaid with the SPX. And all I want to point out in this one, we talked about it in the pre-market live stream this morning, is that usually for a deeper, like quote unquote, big recession to unfold, you need unemployment at, historically high levels, some sort of uptick in this area. So notice that every single time a correction starts in the market, correction starts, this is of course the sickness. So that's kind of an anomaly. Correction has already started, but look at what's going on with employment. It's actually this is the unemployment rate, I should say. Unemployment rate is continuing lower instead of, in this instance, ticking higher. In this instance, ticking higher. The only instance where it actually moved lower before higher was the .com bust. Here it was already elevated, and here it was already elevated as well. So unemployment is in a level where, you know, we're not really seeing any big warning signs yet for a big sort of rollover to the downside. Now, I know there's the complete argument that some people aren't, you know, working the correct jobs and it doesn't align with their skill set. I totally get it, but for now, based on the data, this is kind of what we have in front of us, all right? So that's been sort of a more fundamental look at the macro sort of narrative here. I'm just not seeing the evidence based on what we've just described in both of these charts for a huge downturn or like continued massive bearishness in the market. Now, granted, if we close under SPY 372, we'll change our tone, but so far the macro narrative also isn't really supporting yet the idea that the markets will move lower. They can in the future if things change, but so far kind of hanging in there just fine. Let's take a look at some volatility products now. We'll open up this tab. And first up is the VIX. In the VIX, what we want to just point out is that, of course, we are out of the sort of nasty box from here, but we're still hovering well above 2050. So I don't really see any reason that the market is like content and ready to just chug up towards like 5,000 in the SPY 5,000 in the SPX, for example. Not seeing that data. Of course, just sideways on today's session. Now, everybody and their sister is saying, why was the VIX not lower? Or excuse me, why was the VIX not spiking on a session like today? Let's quickly go back to the SPY. You know, the market's really content with this area. It's not like we were pressing big new lower lows. The VIX will spike as we press new lower lows, but just on like a mild sell-off on a pullback in an overall uptrend, your VIX isn't going to spike, right? So that kind of evidence that we just saw in the VIX being sideways here is also supporting the idea that the market's kind of content with the amount of risk out there, at least as of right now. It's subject to change, of course, but big players aren't really seeing this as like a, hey, let's just, you know, wipe everything and start anew. And another data point for that would be the VVIX, right? If we look at what's going on here, we're at historically low levels. Nobody is hedged out there in the market. So again, either everybody's content with the market being, you know, having put in the lows already, and this is kind of a new uptrend that's forming, or everybody's clueless and we're going to spiral out of control here. This is going to open the door for a big quote unquote flood effect that we always talk about, right? So people are not hedged properly. Everybody's going to rush into SPY puts, VIX calls, and this is going to spike, right? And that opens us up for the flood effect. This would be something that I would watch into tomorrow's session. Remember that follow through day. As we talked about in the internal screen, if you'd like me to do a follow through day on tomorrow's session after the close, let me know in the comments section. If I get enough, you know, comments for it, we'll do it. Next up, we'll take a look at the volatility futures. And the reason being is we want to look for that contango. Is it still in place after the sell-off today? And yes, it is. Right, we've got 2635 and 2660, so the inversion is not inverted. It's actually skewed properly. There's more risk in the future as opposed to right now. So that does check out as indicating that the market participants are more comfortable entering markets currently. Supports the idea that large hedge funds, pensions, you know, money managers need to start allocating. Right, that's what this would indicate. They probably tame themselves a little bit when this is inverted and we're in backwardation, but it's not the case. We're still currently in a mild contango. Now, it is subject to flip. It's only about a 30-cent contango here inside of the VIX future, so keep an eye on it. But so far, hanging in there just fine. Another reason why the market may just be putting in a little bit of a higher low pullback, okay? That's what I've got for you there. Let's take a look at the QQQ NASDAQ 100 equivalent, and we'll move through the remainder of today's video with some speed here. Obviously never got out of its own way, couldn't break out of the balance area to the top side, and we've actually closed underneath here on today's session. We know that tech is more sensitive to rates, so this actually checks out as being fine. It doesn't really strike me as a big divergence. There were actually lower highs going on here instead of equal highs like we saw in the S&P 500. So I would be watching the QQQ. If you're looking for shorts, again, this is the place to be. It's been a value and not growth, not tech rally that we've seen in the marketplace recently. So tech, of course, is lagging based on that. So shorts more attractive in the QQQ, especially noting that we've closed underneath the balance here. Your next short entry could possibly be on a retest for a lower high under 273. Reason being is that was obviously support from here, and we've cracked it on today's session. So a lower high underneath does get attractive if we get a rally first. If we see continued breakdown under 262, opens the door to the CPI gap down low at 255.25. Anything interesting on the hourly chart to share with you? Not really. Again, just sort of reiterating the importance of the 273 level. If we rally first, you can see it's a backtest of this support from in here, and also where the FOMC sort of rally started and then collapsed from, right? So underneath that 273, that is the number in the QQQ. Let's take a look at the IWM Russell 2000 and the small caps. This again is a bullish data point in my estimation. I can't stress that enough because we are still outside of the original balance on one of the more aggressive pullbacks out there in the market, right? So this is a more aggressive pullback on a percentage basis than what we saw in the S&P 500 500, and this is possibly setting up for a break, retest, and rally. We're still above 177. Something that I'd like to show you on today's session is this screen here, which are the three big indexes side by side on a weekly chart, right? So just look at the pullbacks. Obviously, we know that the S&P is looking at this range, the QQQ is looking at this range, and the IWM is looking at this range. SPY, bullish. IWM, bullish. Qs are the ones who's lagging. Tech is lagging here, and IWM, as we've pointed out in like multiple videos now, has really led the market in terms of the relative strength, right? Never made the new lower low, closing low at least, underneath the June low on the CPI gap down, never broke down out of its balance area originally from the September lows, and now it's still well above the balance range. So if the IWM turns around at 177, I would read into that as a bearish piece of evidence, looking for the SPY to actually rotate back higher as well. That's been the broad market. Let's go back to our traditional setup with the day and hourly. We'll maximize that daily, and we'll run through the core list of companies now, again, keeping it brief so you can get out of here in time for dinner. What do we see here in Apple? Certainly a bearish chart. I'm looking at the rotation underneath 146.25. This to me looks like it wants to continue in the downward direction, noting that this was kind of our line in the sand from the weekly watch list video that we talked about on Sunday. Now that we're underneath it, again, looking for bearish opportunities on lower highs or just continued movement underneath to get us here into 138.30. So bearish stance in Apple, no doubt about it. Again, would I advocate for a new money short here? I don't entirely know, given that we've got the 100% retracement of the earnings move. I would love to see like a lower high first, look to short on that lower high for better risk reward, and then we're looking for those downside targets. So overall, Apple, bearish tone, but maybe watch for the dead cat bounce first. Netflix, certainly bearish as well, falling out of the bull flag from up here in the lower third of the nicely divided range that we were talking about in the weekly watches video. Your next trade is simply underneath the bottom of the range at 265.25 to close the gap to 250. If we just chop around in the midpoint, I would not want to be interested in touching Netflix in there, noting that that is sort of like a no-go zone. Please don't diddle in the middle. That is the famous saying. You want to wait until we get to the edges where your opportunity exists for a fade or mean reversion. Mean reversion or a breakdown. Same thing is true, but opposite on the upside as well. That's Netflix. Next up, we've got Tesla, which did not really give us the look that we wanted here. Tesla, we were looking for more of a bullish outcome on the weekly double bottom, holding up above it. You could also start to it's ugly, but cup and handle, right? Never really got out of its own way on the gap up from the Tuesday session, and of course, falling with the remainder of the market. I would look bearish inside of Tesla, honestly, because of the failure of this pattern, right? Technically, we have a look above and fail. Target should be the bottom end of the range here at 205.25. So what would I say in Tesla? Any rallies that fail underneath 222.25, bearish. Look for shorts up against that. Tight risk reward. Stop above, entry here, start to retarget some of the lows. Beautiful, right? 2 to 1, 3 to 1, 4 to 1, depending on how you play it intraday. That's how I would look for downside inside of Tesla. If we just continue to the downside, it might be a little bit tricky to pull off. You'd need to watch for an intraday setup, noting that, again, here's a balance range. What did we just say about the middle? Don't diddle. Next up, we've got Google. What's going on over here? In Google, we know that XLC has been bearish. We know that Google is also a big reason that the XLC is bearish, breaking down from this balance. Break, retest, and go. I would not chase new money shorts inside of Google. I do think that the chart's weak. I certainly wouldn't advocate for new money longs, but I just don't think that now is the ideal time. I think it would have been on the breakdown of these lows or some sort of short early on today's session for the rotation lower here. If you're already short, then fine, hold it. Again, we've got a really weak close down at the lows, but I think initiating something new down here just opens yourself up for poor trade location, right? If this does rally, then where are you going to place your stop? You don't really have structure yet. So I would wait for a rally if you're looking for a new short. If you've got a short, just hold on to it as long as you can, trail your stop lower, protect those profits. Definitely more of a bearish look in Google. Next up, we've got the metaverse, the failed metaverse, apparently based on Mark Zuckerberg's spending habits. Let's see what's going on here from a little balance perspective. It was here, the 2-day balance from earnings gap down, and then it was just all lower after that. So I still think that there's some room to fall to the downside. 84 here. Again, new money shorts, maybe not chasing them here. Wait for like an intraday rally at minimum and then kind of roll over. If we look at the hourly chart, this is going to be a little bit more telling. If we do something like this, so it's easier on your eyes, there we go. Notice how we get like the break and retest. Again, you don't want to be shorting dead on the lows. That would be the equivalent of shorting here, having to hold through this and then waiting for something like that. So just be patient, wait for possibly a lower high to be formed underneath 92 would be the number I would use going forward. So here we go, doing a little bit of live analysis there, live level spotting. 92.50, right? Anything under 92.50, that's more attractive for your downside in Meta. Next up, we've got NVIDIA. NVIDIA is actually a bullish chart, if you can believe it, based on what's going on here from the daily perspective. Again, holding up towards the highs, a little bit of relative strength. Hopefully you can just see that from a visual perspective. I mean, it's not gapping down like Google and Meta, but nonetheless, I mean, bull flag is still kind of in play here. Now, it's a bearish engulfer. We looked above the highs of those candles and we failed. So from that perspective, yes, a little bit more bearish, but what I would watch for is, can we pull back into this area and rotate off of it for a cleaner higher low? Notice how this thing has just been marching in the upward direction. It consolidated for a little while sideways through time, but I would love to see the higher low pull back through price into 127. So watching 127 as a possible buy point in NVIDIA, watching for hammer candles down here, watching for intraday double bottoms, intraday inverted head and shoulders, right? Anything that kind of signals a reversal, 127 is your number. If we do just pop back up in, watch for consolidation and a possible reattempt at the bottom of the gap, 145.50. Next up, we've got Microsoft. This, just like Google, is much more bearish, just like the metaverse is much more bearish. There's kind of your original range, back test, break, retest, go, right? Equal lows here. Not advocating for a new money short, just because, again, we've got the 100% retracement phenomenon. Instead, wait for a lower high that's ideally produced underneath 225.80 from the 2-bar lows right here. Boom, that opens up your short trade to the downside. Stop over the highs, entry, sort of risk reward makes sense, right? That's what we've got inside of Microsoft. I would not flip bullish on this unless we got a clear higher low above 225.80. It's got to be a higher low over time. Maybe intraday, right, on like a 30-minute chart, hourly chart, if we put in a higher low above, but I would love to see it on a daily, to be honest with you, to get a little bit more confidence that, yes, we are accepting back into this range, and you know the deal. That would be a look below and fail on the micro range here into 235.10. So one step at a time, but definitely more of a bearish slant inside of Microsoft. This is probably a favored outcome with the lower high there. Next up, we've got Amazon, last but not least, the mini beast before the 4 trade ideas, completely falling apart. Again, just like what we've been saying in Google and Meta, probably not advocating for a new money short here yet. I would wait for a little bit of an intraday rally that fails, some sort of lower high under 97, then look for your rotation into 86. So about a 10-point range to still be trading for to the downside if we get the rally first. Just, falling apart here completely. No acceptance into the overhead gap from earnings, even after the consolidation doji. Never held 100, which is a psychological level on the intraday. Just, bearish chart here, no doubt about that. Inside of Amazon, I would look for lower, but only after a little bit of an intraday rally to form a lower high. That's what I've got for you in the core list of companies. Let's get into the trade ideas. MRK is up first. This, of course, is Merrick Healthcare Company. Look at this as a possible bull flag, or look at this as an area of breakdown. So depending on what the market does tomorrow, depending on if we open on a gap up, gap down, inside of range, out of range, whatever, this would be something to watch. If we open in range, treat this as a breakdown point at 99.20. If we open on a gap down, I would watch for a rally to backtest and close that gap overhead. Overall, the reason that we picked this one for today's video is it's an inside bar and also an inverted hammer, So a breach of those 2-day lows, again, if we open inside, does get attractive for a downside move, but opening on a gap down, that's what we would call a quote-unquote professional gap down, does complicate things, and I would watch for the rally first. If you're not willing to take that trade on the rally, again, think about the trend here. I don't know why you wouldn't be, but regardless, if you don't look for that gap fill, look for the rejection off of the fill territory for then a possible reshort into that 96 area, all right? So that's Merrick. Next up is going to be LUV. Which I believe is Southwest, right? Southwest Airlines, outside bar, closing weak on the lows, tested above the highs, complete failure, rotating underneath this 36.50, opens the door into 35.16. The lows from in there, hourly chart might do us some good in terms of looking at the structure. So again, closing and breaking down underneath this level. Next major area of support that we can identify is here, 35.16. Next up is going to be BA, which is also in the airlines industry. This is more of something to watch. This isn't necessarily just a clean trade idea. Look at how we close. I mean, this is like one of the only green closes out there in a solid company that's reasonable, that's not some like obscure penny stock, right? Or a biotech. So overall, really kind of more of a question mark as what's Boeing going to do into tomorrow's session. This isn't a random level at 147.36 just because we closed there. But if we look at the hourly chart, notice that we've got some structure here from some sort of like a bull flag look. Now, if we open above that, I would keep this one on the table just because of its relative strength today for a possible move in the upward direction. If we break down underneath it, probably not really interested in getting involved through this chop here. It's just something to, again, keep on a watch list. If it's bullish tomorrow, that could possibly open the door for some upside in Boeing. Next up, we've got Dow. This is Dow Chemicals, not the Dow Jones. And what's going on here, certainly very similar to LUV, Southwest, right? Look at this big upper wick engulfing all of these candles. So at one point in time, remember that this was a big bullish engulfers bar. We would call that a seller's shut off bar. Takes back 1, 2, 3, 4, 5 days of price action all in one swap. One swap. What am I saying? One swath. Boom. If we short underneath those lows, big failure from the buyers already proven, big upper wicks in place, rejecting the 50 SMA. We've got a little bit of a downtrend in place from that perspective. Cracking these lows opens the door through this rotation to the bottom at 45, right? Again, here's the hourly chart to possibly make that a little bit more clear. Big break of support. Next target underneath through this kind of thin structure on the rally, at least from there, is coming from here with other data points at 45. So that is going to wrap up today's video. Let me know if you enjoyed it down below in the comment section. I feel like we've been doing a decent job of showing some different charts than normal. If it's distracting, let us know as well as a form of feedback, and also let us know, I know that's a lot of things to let us know on, is if you want tomorrow's video, right? Should we do a follow-up day to FOMC or not? With that being said, I wish everybody a green trading week into the close. We will be live tomorrow morning at 8:30 as we typically are. And with that being said, I will catch you in the next one.